Hey, it's Rick. It's Wednesday, the 1st of February. Now that January's in the bag, a couple things I want to go over. I'll review my stats for January and how they stack up against last year. Then I want to talk about the concept of overhead supply, which probably doesn't get enough discussion, but it's something that you should be aware of in your investments. But let's start first where we always do with our model. And for the first time since I've started doing this, uh, something like 8 months ago, where all cylinders are pointed up. Um, Everything's above the 8-day, all the moving averages, and all the moving averages are now trending up. Even the 200-day is not actually turning up on the spiders, but the 30-week moving average has actually started to trend up. So I'm not sure why the disparity between the two. So anyway, it's a good sign. Looking at my stats for the month of where are we here? Month of January. Just pull those up. This is how I did January, and this was all of last year combined. So this month I had 8 winning trades, 16 losing trades, 4 break even. And the break even I define as a gain or loss of $50 or less. That fits in the break even column. So my batting average was 33%, 8 out of 24 trades, which is identical to my full year of last year. So I haven't been able to improve that. I'll get to that. I'll get that in a little bit. Right now I have about 13 or 14 open positions, and about 10 of them, all but 4 are profitable. So I expect this batting average may improve in the month of February. Let's keep our fingers crossed anyway. My average win was 6.5% versus last year's historical was 3.5%. So that's a substantial improvement. A little bit of improvement in my average loss. It was only 1.7. My average loss last year was 1.9. Now, these are very skinny for a lot of you. You're not in front of your computer, so you can't manage your trades the same way as I can. Yeah, in a sort of a passive trading methodology, you'd probably be, your average loss would be probably closer to 4 to 5%, but you'd be looking for average wins in the 10%, 10 to 12% range. But I find, especially this past year, those 10, 15, 20% gains have been really hard to come by. And so I tend to get out of them very quickly. On the same token, my average loss is at 1.7%. I just don't tolerate. If it doesn't go the way I expect it to go, I exit the trade. And I'm always willing to re-enter if it sets up again. But I just don't tolerate it going down. So that's why I've been able to keep my average loss at a very small percentage. My average initial risk, this is the risk that when I open the trade, you're at your highest risk. It's averaged 3%, which is up a bit from last year. It was 2.2. I was being ultra cautious last year, most of last year, especially when conditions warranted it. So we'll see how that goes. But I'm comfortable with 3% initial risk because my methodology of cutting my losses quicker means my average should be substantially lower than that amount. So anyway, that's enough said about that. The Sharpe ratio, which is basically just taking your average win dividing by your average loss. So in my case, for the month of January, my average winner was 3.8 times larger than my average loss. Compared to last year, my average win was only 1.8 times my average loss. So this is a key metric to track. You always, at a minimum, you need to be a 2-to-1, maintain a 2-to-1 ratio of your average winner versus your average loser, unless you're going to have a batting average greater than 50%, or even 45%, 45% or greater, which is I think is exceptionally hard to do. You got to be really skilled to be able to do that. I'm very pleased with this ratio. If I can maintain this, this is going to be an exceptionally profitable year. But 1 month does not. It's only the first inning of a 12-inning game, so we shall see. I also keep track of the number of winning trades that are greater than 3R. And 3R means if I'm willing to risk 3% on an initial trade, if it gets more than my win is more than 9%, then that's greater than 3R. Or if you want to put it in dollars terms, if I'm risking $500 and I get a return greater than 1,500, it goes into this category. And 38% of my trades this month were in that category, which is good. That's a substantial improvement from last year. And this one I'm really zeroing in on. This is the number of losing trades that are greater than 1.5R. So again, using a dollar number, if I'm willing to risk $500 and I lose more than 750, that's greater than 1.5R. Something's wrong. Either I didn't honor a stop, the stop could have gapped down. Those are basically the only two reasons for that. And last year I had 29 of those. And I was guilty of stop violations. I had a few gap downs for sure, but these are all stop violations. And they just kill your account. So this year I have 0 so far. My goal is 0 for the entire year. I don't think I'm going to be able to avoid any gap downs, but hopefully those will be fairly rare. The other stat I'm keeping this year that I didn't last year is the number of days that I'm in my winning trades and how many days I'm in my losing trades. And so far, my winning trades, I'm in almost 14 days, so 2 weeks. And my losers, I only keep for 4 days. So again, this whole philosophy of if it's not going the right direction, I just cut it and move on, or maybe re-enter under better circumstances. So all in all, a good month. I think my account balance was up 3.8% for the month. So that's a good start, way better than January of last year. Now to the concept of overhead supply. So here we have the S&P. And as you go, let's go here to the daily just for a second. And here's January where are we? December the 30th. So we've actually come from here up. The market's up, closed here today, about 7.5% since the beginning of January. So it's been a really good start to the month. So where are we going to go? Are we going to go just straight to the moon? Go straight up like that? This blue line, oops, do this again. The blue line out here represents December 30th, 2023. So that's 1 year from now. So that's one scenario. We could just go right ripping back up to where we were a year ago. More likely scenario would be we're going to give and take. And then if we actually, I'm going to pause it right there. If you see these peaks, remember this downtrend line here, we see these peaks, and to draw a line across, each one of these represents an area of resistance. So let's put this another way. So we're here. I'm going to draw another line here. Change the color of this one. Make this one a bit wider. Make it orange. So that's the price today of the S&P 500. So everything above that, let's actually get rid of these lines here for now. Sorry about that. It's a little confusing. Too many things on the chart. So this is where we are today. So just think of it in these terms. Everybody that bought the S&P 500, if it were a stock, below this line. So all these people here for the last few months, and certainly if you still owned it way back in here, you're a happy camper. At least you're back to, if you bought it around here, you're back to break even. If you bought it here, you're in a profit. But think of all of the people that were bought it in here. They're unhappy. They're still underwater. Despite the fact we've gone up a bunch, they're still underwater. So human nature says when price gets back into these levels, I'll draw these lines back again. When price gets back into these levels, that one there, and certainly at the top, people that bought in there are going to be selling. And then people that bought lower than that are going to see that as an ideal place to take profit. So that's what I mean by overhead resistance. And this shows up better in a couple of names that you might be familiar with. Let's look at Facebook, or what's now called Meta. So this is the week. We're going to focus again on the weekly chart. So it had a big, huge drop down here on, must have been some news of some sort, and it's come ripping back, and it's at 153. But look at all of this overhead supply in here, and if it gets through that, you've got another bunch of overhead supply here, and then when it gets through that, you've got all of this up here. So yeah, the stock could well get back to 300 and change, but boy, it's going to be tough slugging to get there because you've got all of this stuff to get through. And just as a side note, Meta announced their earnings tonight, and the stock is, if it stays the way it is right now, the stock is going to open about $184, right about here. If I were more aggressive and I were a day trader, I'd be shorting it tomorrow morning. Because again, this whole notion, all of these people in here are going to be peeing their pants to sell it because they're getting back out even. Everybody that bottom fished all the way down is going to be clapping their hands, and they're going to take this big profit tomorrow. And so again, that's how overhead supply can impact your decisions. Look at Tesla. Again, I mean, it's had a nice move up, but you've got all of, just drawing a line from today's price, everybody above that line is underwater. So when price gets up back into here, there's a lot of sellers up there. And then the bottom fishers down here are also going to be selling. So that's sort of the notion of overhead supply. So I like to find stocks that have very little or none overhead supply, because then all I have to worry about is the people that are going to take profits that are selling from below. And so I'll give you a few examples of that. This is a stock I bought a couple of days ago. It didn't work. You can see if I drew a line across here, there's no overhead supply. So it went above this and then quickly failed over the next 2 or 3 weeks. So I got in it over here, and then I got stopped out today. But you got to know, this is on my radar. I'll take a small, tiny loss in here and look for a better entry and look for this one to come back up again, because unless it just keeps on going down. Obviously, if it keeps on going down, then all bets are off. But as long as it hangs around in this area here and sets up again, I'll take this trade. Linamar was another example of it, except here you can see this is a beautiful, what Mark Minervini refers to as a VCP pattern, a volatility contraction pattern. So you come down, a shallower decline, and then blast through. I bought this one here, and I sold it all today. I sold a piece here, and I sold 2 pieces of it up here. And why would I do that? Because it's ripping up. But look at all this supply over here. The probabilities suggest that it's going to be tough slugging to get much more out of this. So I'll take what it turned out to be a 6% gain in 2-3 days. So I'll take that and just run to the bank. So looking at a few others, this aerospace company. Again, look at this long base. Price is up here, and there's just no overhead supply. So again, there's the only, I mean, there could be people that are quite willing to sell at 44, or 42. They're not obvious to us. And you could say, well, look what happened a couple of times, went way down here. It set came up here to a new high and then went down. Came up here to a new high and then went down. And then here and went to a new, went down. And it could do this exactly the same thing again. It could go from here, could go down. But do I care? I have a stop. I'm in here. I have a stop loss, and that's what stop losses are for. So if it goes down, right, I sell it, I break even, and I wait for it to set up again. So, but the probabilities are far greater if that it's going to continue to go up. It's a position at INSP is one I bought today. Again, it's got a bit of overhead supply. Not much when you draw the line of today's price. There's very little. For a couple of weeks, it traded above here. This time it traded above and then crashed. So it must have been on earnings or something. So it could do the same thing. It's tightened up really in here very nicely. And yeah, it could easily come down here. But you can see over on the daily, there's where my stops are. So I've defined my risk. And I won't bore you with all the math on here, but from my entry point, half a stop here and a half stop here, it's about 3%. So I'll take a 3% loss on the chance that it does drop like a stone. But again, playing probabilities, if this goes up here, it could rocket up 10-15%. I love this company because it's got a great symbol. They're RICK. It's a restaurant chain of restaurants, I guess. But again, no overhead supply. Now this one's not working. I bought it. Where did I buy this darn thing? I bought it here. Oh wait, this day here. And then now it's falling apart. So my stop, I got stopped out at half of it up here, and then I'll probably get stopped out in the other half under here. But again, this one will set itself up again, perhaps, or just keeps on going down and it'll go off my radar, and that's the end of it. Texas Roadhouse, another restaurant chain. Again, overhead supply from here, from today's price. It's only 1 week, 2 weeks traded above this level. So there's a bit of supply that goes back to April of 2021. So that's a long ways back. And and everybody under here is a happy camper. So I don't see much selling until, who knows? Why can't this one go from 100 to 125? So I think you get the idea. I won't go through all of my positions, but hopefully that this little video will make some sense on how to look at a chart and look to your left and see if there's any congestion out there. Like, again, just go back to some of these other examples. Take Apple. Apple's, yeah, if you draw a line from where we are today, you got a lot of unhappy campers up here that are just dying to get their money back. So yeah, it can go straight up. It can go back up to 300. But that's a tough slug to get through all of this. And if Apple's going to do that, can you imagine some of those other companies that I'm in, or that have no overhead supply, how far they would go and how much quicker they will go there. So anyway, that's enough of my rambling for tonight. hopefully the rest of the week will be good. So maybe get another video out by the end of the week. Cheers.